If you are an options trader, here's a simple hack for calculating profit and loss potential before making a trade. That's going to blow your mind. So the question about how to calculate your profits on an options contract, whether it be a long call, credit spread, iron condor, butterfly, whatever it may be, came to me from a coaching student. So shout out to Karen for submitting that question. Great question. Here's how we're going to look at it today with this free resource, optionsprofitcalculator.com. Make sure you star that and add it to your watch list because it is a key piece of tech that you can use to your advantage as an options contract trader. Let's get into it right here. Let's go down to the beginning, the very basic kind of long call. If you're buying long calls, you're buying, hoping the market's going to go up. Let's show you how this works in real time so you can do it yourself. So in here, first thing you got to do is you have to go in down here and you want to click on long call and just click on the symbol, put the stock symbol that you want to trade on. For our purposes, let's go with Apple because it is the biggest company in the world. Top spot gets top dollar here. It's going to get price. Click there, current stock price. Just note this is going to be delayed data once the market's open. It's going to be delayed by about 15 minutes, but for our purposes here now, market's closed, so we're good to go. Current price 175.5. Now, you can either buy, which is buy, or you can write, which is sell. If you're going to sell a call, you're hoping that the market's going to go down, but we're going to buy a call, which is kind of the beginner level way people are trying to trade options. They buy calls or buy puts. We're going to buy a call option, and hopefully the stock price is going to go up to be profitable. We're going to see how much profit we can actually make by buying this call option. Next, we're going to go down here and go options. So we want to go through here, click option, and this chart's going to pop open. And what we want to do here, we can see the different strike prices along the top right there. You can see them. They go all the way up to January 2025 out to the leaps there. We don't do that. We're going to go, let's go out let's go out to the third Friday in June, the 23rd. Click there. You can click any kind of expiration date you want here, but I'm just going to do this one right now. And it'll show you, again, a 15-minute delay on the data, but it's going to show you the calls and the puts here. And we're looking at the call side. So we want to look at maybe around what the price is at right now. The 175 would be at the money, right? It's kind of cheap. The further away we go, the more we're going to have to pay. Let's go right around here. Let's go at the money or right near the money, 170. So 857 is going to be the price that we want to have for our option. And we're going to do one contract to start. So it's going to cost us $857 to buy this call option. Now, the exciting part is seeing where the stock price needs to go in order for us to make a bunch of cash. So if we go in here at the bottom down here and go, before we click calculate, we want to go down here and say stock price range. If we go ahead and click calculate, it's going to automatically calculate it for us. But let's go ahead here and set it to 140. So $35 below the current stock price. And let's set it up here to $35 above that. So it's going to be 210 if my math serves me correctly. If it doesn't, make sure you let me know in the comments because I'm not the best with math, mental math sometimes. So now we're going to click on calculate, and this crazy little chart's going to pop up down here. Now this is where it gets exciting. Okay, so it's showing us right now the maximum kind of risk and the percentage return. The percentage return in green is if this price goes up and it works out in our favor. The percentage return in red or below this line right here, or even over here, the negatives is down below because that means the stock price went down. You can see the price of Apple going up and down on the left-hand side. It goes all the way down to 140. You're going to lose your entire premium. If it goes up to 210, you're making some big time money at a 372% return. So right now it's showing percentage return in the chart. And you can see that if the stock price, right, it goes up to 210, the day after, like if it went up there today, let's say it went to 210, it just shot up, you could make 372%. But the longer you let this contract kind of sit there, the more that theta's value is going to kind of erode it away, and you're going to start losing some of those gains just because if the stock price stays there, the amount of theta you're going to be chopped off this price is going to be chopping off a little bit by every day. But you're still going to be profitable up there at 210. If you're closer to the money at 177.5, right, you're going to be up 17%, so you're going to make some money. But as you go over time, if it doesn't get there right away, eventually, if you're at June 13th here, you're going to be negative percentage on your trade. So you're actually going to lose money even though stock price has gone up. So it's important to understand this. But you can see in here, if you know where the stock price is likely to go or have an idea where it's going to go, you can do this. You can say, I think Apple's going to 190. Okay, 190. And I think it's going to take me 2 weeks to get there. So 2 weeks out, roughly 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 on the 11th, 185, 190. Okay, 137% return right there. You're up 100, you're up $1,100 on the trade. Conversely, if you have an idea and you want to see how much money you're going to lose, you can say right there, bam, 100% right there is my loss if it goes to 170 and I don't close it out till expiration. But if I go and it goes maybe a couple of weeks, that same 2 week window to the 11th of June, and we go down all the way to 160, I'm losing 95%, 94% of my contract. I'm going to be down $804. So you can have an idea of where you want to maybe set your stop losses if you're using stop losses for a contract with options. And you can see kind of how this is going to change in time. And obviously, the longer you go out in time and the worse it gets, the more you're going to lose. 99, 100% down here. All these scenarios are 100% loss of your capital, which is why it's always important to use a stop loss. But you can also change this chart to change it from maximum risk to profit and loss, which is what I think a lot of people want to see, is just give me the dollar values. Give me the dollar amounts right here of what I'm going to make. You can see I go here, boom, 190 by June 17th, $1,100. If I go 205 by June 20th, 26.49. So that's the kind of the quick hitters. If you want to go like a couple days out, May 31st, we're up to 185. We go up $10 in stock price. I'm making $755 on my $800 trade. So it's almost 100% return. Conversely, if the stock price goes down to 170 right away, you're losing 335. If it's down by 170 again after a few days, you're down to 412. And you can kind of pick and choose here where you can see where the option may go, may or may not go, and use it for your calculation that way. You can also change the chart here from a bar kind of table like we have right now to a more linear kind of graph. And I like this one because it shows you, again, the amount of dollars in profit right here, quick little load. You can see very quickly where the stock price needs to go in order to be profitable. You want to get above that $0 amount. So right here, right, want to get above there. So we need to get right around that 175-ish, 180 area is going to get you profitable. And the further you go down this range, the more you're going to make in terms of pure profit. If you want to flip it back over, you can do that as well. You can also play with the volatility of the stock, and you can change that to see how that's going to update things. It's going to kind of just beef up some of the returns and make it go a little bit quicker. And sometimes if IV changes, you can play with that as well if you want to. You can also go down here and tighten this range up. You can go down and just say, I want to go from 170, and we'll go up to, I don't know, 180 or 180. Yeah, let's do that and update the range. This is going to give you a more kind of micro kind of chart about what's going to happen. You can see here, it's a lot of kind of red on this chart because you need the stock price to move if you're buying call options. If you're buying options in general, you need the price to move in your direction and move quickly. The quicker it moves, the more money you make. So you can see here, if it moves up to 177 initially, you're going to be in the money. And again, if you don't decide to close that contract out, you're going to end up losing money overall if you let it go out in time just because of theta and time decay on the options contract. The nice thing about this site as well is that you can see that these charts, but you can also go ahead and just keep these kind of options finder in here. You can keep the kind of running tally of your different ideas of what you want to trade for future reference. And you can also see the probability of profit right here as well, like you can on most trading apps. You definitely can on interactive brokers as well. It's going to show you your profitable percentage, and you can see there how you're looking. If you want to print this and send it to other people, you can get the short link to share it. You can share this with other people, share it with different traders in your group, in the Discord group, online if you want to. So let's go back up. Let's look at one more strategy here real quick. Let's go at naked puts. Let's say if we want to sell a naked put contract. Instead of buying, we're going to sell this time. We're going to go and do it on Etsy, just because that's the first thing that pops in my mind. So Etsy, assuming you have an idea of where you want to sell a put contract at, you can get the price right here. It's going to load in there in a second. And we're going to be buying or selling. We're going to be writing. So we're going to be selling. We're going to select the option again from our trusty little kind of guide right there. Let's go up in time a little bit. Let's go to the 30th of June, a 30-day expiration. Sounds good. And we're selling puts here, which means that if the price of Etsy goes down to $80 per share, we end up buying 100 shares of Etsy for $80 per share. We're going to get paid $270 to do this. And we're going to do one contract again. And we're going to just leave the stock price range blank to see what it does for auto right now and calculate this up. Now you can see here the chart looks a little bit different. It's a little bit more green than the other chart because the options selling of a put option is a kind of a defensive strategy. It's bullish, but it's also defensive in that your loss is kind of capped, and it gives you some room for wiggle room if the price does drop down. And you know, if it goes down to $80 per share, you have to buy the stock. If it doesn't, if it's about 82.33 after a few weeks right there, you're still making money as long as data decline is happening and the price is at 82. So the stock price can come down about $3, $4 even. You can still make money on this kind of contract, just about using kind of what kind of contract makes the most sense, what kind of strategy makes the most sense for your different trading account. And obviously, again, if the stock price does go up, which is what you want it to do, you're making money, but definitely not as quickly as with buying a straight up call. This is a defensive contract. It takes time to kind of decay away, but you can see that the percentage of profit on this one is 77%. So you have to kind of do the risk reward. Hey, with my buying of an Apple call, I have a lower percentage of profit, but a different kind of range in the profit that I can get. If the profit here is only $278, it's not as much, obviously, in the 3,000s, but your profitability is way up at 77%. So take each one with a grain of salt, and then obviously you can go back up and change this again. Let's look at a credit spread. Let's do that way. So symbol, we're going to look at NVIDIA because it's been crushing lately. Get the price. And we want to select an option to buy first. Okay, credit spread. Let's do let's do a put spread. So we're going to buy this guy right here, 385, and we're going to sell a put option as well. We want to make sure we sell above the one that we bought so we make a little bit of cash. So our net credit is $1.10. We're going to calculate this up again. And you can see now we have a much smaller chart. The stock range is very tight. If we go down here and open this up a little bit more, let's just go 370 to 410. And NVIDIA has been crushing it lately. Open this up. And you can see that this profitability is 58%. But again, if you drop it on this trade and start dropping quick, your likelihood of losing cash is increased. But it's limited again because of the kind of credit spread nature. You're only putting up $1.10 of potential kind of capital to be for risk. And the price is kind of capped there as you go down the downside. So it shows you the percentages again. You can see before you make a trade what your likelihood of profit is, where your sweet spots are for profit, and how you can go through and just make better decisions, more informed decisions on your trading. Use this quick tool for a quick glance at your options contract. One last thing is that I would always recommend trading in real time, which this site doesn't do. And also when you're selecting your contracts, this is very limited value. It's just the calls and the puts and the bid-ask spread. It's not giving you anything about open interest. It's not giving you anything about the kind of positions that are out there or where there may be pinpoints in the market. So make sure you understand what those are and make sure you understand where the kind of the areas of support and resistance are for these numbers on the chart as well, given the stock price. Do your technical analysis, combine it with this, and use these charts to pinpoint your profit areas where you want to go and get in a trade and set your stop losses on the downside. If you want to see how to set a stop loss quickly with Interactive Brokers, make sure you check out this next video right here. Thanks for watching this one. So much appreciate it. Consider subscribing to the channel if you haven't already, and I will catch you on the next one.